Have you ever wondered what an investment banker really does? Well, beyond the huge numbers, they've got this kind of superpower. They can look at any company, your local coffee shop, a global giant, and see it through a purely financial lens. And right now, you're going to learn how to do it too.
But let's just forget the dry textbooks for a minute. We're going to learn the exact skills bankers use on billion-dollar deals by following the real-life story of one iconic brand that went from a downtown street all the way to Wall Street.
And that brand is Supreme. Yeah, you know them. It started as this one little skate shop in Manhattan and just blew up into a billion-dollar streetwear empire. Its journey, from a private company to being bought and sold by major players, it's the perfect way for us to see exactly how bankers think. So let's start at the very beginning.
Okay, so our story kicks off in 1994. To understand any business, you got to speak its language. And that language is accounting. It's really all built on 3 key financial statements that tell you pretty much everything you need to know. First up, the income statement. Think of this as the story of a company's performance over a certain period, like a year. It really just answers one simple question. Did we make money or did we lose it? You start with all the money coming in at the top, you subtract all the costs, and you end up with a final profit at the very bottom. So let's imagine Supreme's first year, right? Maybe they sold 1,000 t-shirts for $30 each. That's $30,000 in revenue, what bankers call the top line. From there, we subtract the cost of the actual shirts, rents, salaries, and of course, taxes. And what's left over, that's $7,150, that's the net income. That's the bottom line. It's the real profit. Next up, the balance sheet. Now, if the income statement is like a video playing out over time, the balance sheet is just a single snapshot, a picture of a company's financial health on one specific day. And it's built on one single unbreakable rule. What the company owns, its assets, has to always equal what it owes plus the owner's stake. That's liabilities plus equity. So let's say at the end of 1994, Supreme's assets, the cash in the bank, and all those t-shirts in inventory totaled $15,000. Well, that is balanced perfectly by its liabilities, like the money it owes its t-shirt supplier, plus the equity from the founder's own investment and the profits it made. They have to balance. That's why it's called a balance sheet. And the third key document is the cash flow statement. Now, this one is so critical because, as they say on Wall Street, cash is king. You know, a company can look profitable on its income statement but still go totally bankrupt if it runs out of actual physical cash. This statement tracks every single dollar coming in and going out, and it gives you the true picture of a company's health. All right, now let's hit the fast forward button. We're jumping 23 years into the future. It's 2017, and a huge private equity firm, the Carlyle Group, buys a 50% stake in Supreme. Now, the price they paid implies the entire company is worth $1 billion. So how on earth did they get to that number? How do you even put a price tag on a business? Well, this brings us to a really important idea in valuation. First, there's something called equity value. That's just the price of all of a company's shares. But then there's enterprise value, and that's the true cost to buy the whole shebang. The best way to think about it is like buying a house. Equity value is the price tag on the house, but enterprise value is the price plus the mortgage that you have to take over. See, to own the entire company, the whole pie, you can't just pay the shareholders for their slice. You also have to cover all of its debts and other financial obligations. Enterprise value is the total amount you'd need to pay to own 100% of that business, totally free and clear of everything. Okay, so we know what we're solving for. That's enterprise value. But how do bankers actually calculate it? Well, it's kind of both an art and a science, and they have this toolkit with 4 main methods they use to figure it out. And these are the big 4. You've got 2 methods that are all about comparing to other companies: trading comps and transaction comps. And then you have 2 methods that are about the company's own potential: the discounted cash flow, or DCF, and the leverage buyout analysis, the LBO. Each one gives you a different angle on the company's value. So let's walk through them. First up, trading comps. This one is all about relative value. You just ask, hey, what are similar public companies worth right now? You look at a key metric, like their enterprise value divided by their EBITDA. That's just a fancy term for a company's core profit. So you see here, the median for peers like Nike and Adidas is about 12.9 times their earnings. If we apply that same multiple to Supreme's earnings, it suggests a value of around $1.3 billion. Transaction comps are, you guessed it, very similar, But instead of looking at stock prices, we look at the prices that were actually paid in past acquisitions of similar companies. Now, these deals often include what's called a control premium. An extra chunk of cash you pay to get full control of the business. And that's why the multiple's a bit higher here, which points to a valuation closer to $1.5 billion.
And now for the most famous method of all, the discounted cash flow, or DCF. This isn't about comparing to anyone else. This is an intrinsic valuation. It values the business based on its own future potential. And the core idea is super simple. A dollar today is worth more than a dollar tomorrow, right? So a DCF just projects all the cash a company is going to make in the future, and then it discounts it all back to figure out what that's worth in today's dollars. And finally, we have the LBO analysis. This helps figure out what a financial buyer, like a private equity firm, could actually afford to pay. It's that house analogy all over again. You're using a tiny down payment, that's the equity, and a massive mortgage, which is the debt. The plan is pretty simple. Use the cash the business generates to pay down that giant loan over time. So why on earth would you use all that debt? Because that financial leverage, it juices your returns. It's rocket fuel. By using this strategy, when Carlyle sold its stake in Supreme just 3 years later, they made 3.8 times their original investment. Now that is the power of a leveraged buyout. Now, the LBO gave us one answer. But here's the thing, no single method is ever perfect. And that's why bankers combine all 4 analyses onto a summary page they call a football field chart. Looking at all these different valuation ranges side by side lets them triangulate all the data and land on a final defensible price tag for the company. This brings us to the final chapter of our story. In 2020, Supreme gets acquired again, but this time by a publicly traded company, VF Corporation. And for a public company buying another business, there is one last absolutely critical question that they have to answer. And that question is all about earnings per share, or EPS. For any public company, this is one of the most important numbers for their shareholders. So before they do any deal, they have to know, will buying this new company make our EPS go up, making the deal accretive, or will it make it go down, which would make it dilutive? The basic math here is actually pretty straightforward. You just compare the buyer's standalone EPS to what the new combined company's EPS will be. So in this simple cash deal, you're adding all of Supreme's profits to the total, but you're not adding any new shares. And what's the result? Well, the combined EPS goes up from $2 to $2.15. The deal is accretive. Wall Street is happy. And there you have it. I mean, from the language of accounting to the 4 core ways of valuing a company to that final accretion/dilution test, that right there is the foundational toolkit investment bankers use to analyze businesses every single day. You've learned how to decode the finances, how to put a price on a brand, and how to judge the impact of a billion-dollar merger. So really the only question left is, now that you have the banker's lens, what business are you going to see differently?